In the endless torrent of financial news, in the daily drama of stock tickers painting charts red and green, there exists a profound and dangerous illusion. The illusion is that the noise is the signal, that the quarterly earnings report, the analyst upgrade, the breathless headline about a new product is the truth. We are trained from our first investment to watch the scoreboard, to react to the commentators, to believe that the game is played on a screen in 15-minute intervals. But what if the entire game we're taught to watch is a sideshow? What if the real contest, the one that determines fortunes over decades, is happening off the field, in quiet boardrooms, driven by a force so powerful and yet so subtle that most investors don't even know its name? This force pushes brilliant, high IQ executives to make catastrophically stupid decisions. It compels entire industries to march in lockstep off a cliff, cheering their own demise. And it is the single greatest destroyer of shareholder value in the modern world. Warren Buffett, the man who has built an empire of capital by ignoring the noise, gave this force a name. He called it the institutional imperative. It's the mindless tendency of corporations to imitate their peers, to expand for the sake of expansion, to resist any change that deviates from the industry norm, even if that norm is suicidal. It is a form of corporate insanity, and it is everywhere. But Buffett didn't just diagnose the disease, he engineered the cure. A single question. A mental scalpel so sharp it can dissect any corporate strategy, any CEO's rationale, and lay bare the truth in seconds. It is a question that instantly transports you from the chaotic stands of the public market into the quiet, rational mind of a sole, private owner. This is not a story about a stock tip. It is about acquiring a new form of sight. It is about learning to ignore the scoreboard and instead understand the fundamental physics of the game. Because once you learn to ask this one question, you will never look at a business or your own journey to financial freedom the same way again. The story begins not in the gleaming towers of Wall Street, but in the decaying heart of the American industrial past. It begins in New Bedford, Massachusetts in 1964. The air there was once thick with the hum of looms, the scent of cotton dust, and the promise of prosperity. By the time a young Warren Buffett entered the scene, that hum had faded to a death rattle. The New England textile industry was dying. Foreign competition with cheaper labor was a relentless, unstoppable tide. Every rational analysis, every shred of economic data pointed to one brutal conclusion: the game was over. Yet, inside the boardrooms of these textile companies, a strange delusion persisted. This is where Buffett, having taken control of a struggling mill called Berkshire Hathaway, got his first, brutal education in the institutional imperative. He watched, with a mixture of horror and fascination, as the executives of competing mills, men with decades of experience, made the same irrational decision over and over again. They took the meager cash flow their dying businesses generated and poured it back into the fire. They bought new, more expensive looms. They expanded their plants. They invested millions in a business whose return on that capital was guaranteed to be abysmal, if not negative. Why? Because they were textile men. And that's what textile men did. Their entire identity, their careers, their place in the New Bedford business community was tied to running and expanding textile mills. To do anything else, to shrink the business, to liquidate assets, to admit that the core enterprise was a dead end, was unthinkable. It was a violation of the unspoken code. Their peers were buying looms, so they bought looms. The industry trade magazines celebrated new capital expenditures, so they issued press releases about their own. This was the institutional imperative in its purest form, the mindless imitation of peer behavior, untethered from any rational calculation of long-term value. Buffett himself was not immune. For a time, he fell into the same trap. He approved capital expenditures, trying to wring out a few more years of life from the looms of Berkshire Hathaway. He later described this period with brutal honesty, calling it a colossal mistake. He was pouring good money after bad, seduced by the hope that one more investment would turn the tide. The money he spent on new equipment for the textile business in those years produced no meaningful return. It was, in his own words, vaporized. The turning point was a moment of profound clarity. He realized he was not playing a financial game, he was fighting a psychological one. The force compelling his competitors, and even himself, was not economic logic. It was social proof, it was commitment bias, it was the fear of being different. And so he did something truly radical. He began to starve the textile business of new capital. Instead of reinvesting the cash flow into more looms, he started siphoning it out, using it to buy into wonderful businesses completely unrelated to textiles. He bought an insurance company called National Indemnity. He bought a stake in the Washington Post. He was acting not as a textile man, but as a capital allocator. He was breaking the iron grip of the institutional imperative. This foundational anecdote, this painful, multi-year struggle with a dying textile mill, is the origin story of Buffett's entire philosophy on management analysis. He learned, in the most expensive way possible, that the behavior of an institution is not governed by the IQ of its leader, but by the gravitational pull of its history and its peer group. The managers of the other textile mills weren't stupid, they were trapped by an invisible force that demanded conformity over rationality, activity over results. And Buffett's escape from that trap formed the bedrock of his empire and gave birth to the critical thinking that would define his legacy. He saw that the most important question in business strategy was not, what is our competitor doing, but what is the rational thing to do, regardless of what anyone else is doing. The phenomenon that Buffett observed in those New England textile mills is not an anomaly of a bygone era. It is a deeply human trait, a cognitive bias hardwired into our cerebral architecture. The underlying psychological principle at play is one of the most powerful forces in human society: social proof, more commonly known as herd behavior. From an evolutionary perspective, this bias makes perfect sense. For our ancient ancestors on the savannah, seeing the rest of the tribe suddenly sprint in one direction was not a moment for quiet, independent analysis. It was a moment to run first and ask questions later. The one who stopped to investigate the cause of the panic was likely to become lunch for a saber-toothed tiger. Conformity was survival. Our brains are therefore programmed with a simple, powerful shortcut. If a lot of people are doing something, it must be the right thing to do. In the boardroom, this ancient instinct manifests as the institutional imperative. A CEO is not a dispassionate calculating machine. They are a human being swimming in a social context. They attend the same conferences, read the same trade journals, and sit on the same interlocking boards as their peers. When a rival company makes a large, headline-grabbing acquisition in a hot new sector, like artificial intelligence or cloud computing, a powerful wave of social proof washes over the entire industry. The board members start asking their own CEO, "Why aren't we doing that? Are we being left behind?" Analysts start publishing reports questioning their lack of vision. The business press celebrates the boldness of the acquiring company. The pressure to conform becomes immense. The rational internal question, "Does this acquisition actually make economic sense for us at this price?" is drowned out by the thunderous external question, "Why aren't we doing what they are doing?" This is compounded by another powerful cognitive bias: commitment and consistency. Once a company has publicly declared itself to be, for example, a premier textile manufacturer, its entire identity is wrapped up in that statement. Every subsequent decision is filtered through the lens of maintaining that consistency. To liquidate the textile division would be to admit the previous commitment was a mistake, which is psychologically painful for any leader. It's easier to double down, to commit more capital, to prove that the initial path was the right one all along. This is the escalation of commitment that causes people to pour more money into a failing investment, hoping to make back their losses. For a CEO, this isn't just about money. It's about their professional identity and public reputation. They become trapped by their own past pronouncements. The famous conformity experiments conducted by psychologist Solomon Asch in the 1950s provide a chilling illustration of this principle in action. In the experiment, a subject was placed in a room with a group of actors and asked to perform a simple visual perception task, matching the length of a line with one of 3 comparison lines. The actors were instructed to unanimously give the wrong answer. Astonishingly, a huge percentage of the actual subjects conformed to the group's obviously incorrect answer, rather than trust their own eyes. They knew what they were seeing was right, but the social pressure to agree with the unanimous majority was too powerful to resist. Now, imagine the pressure in a corporate boardroom, where the correct answer isn't as clear as the length of a line, where the future is uncertain, and where the dissenting voice risks being labeled as timid, uncooperative, or not a team player. The institutional imperative is the Asch conformity experiment, scaled up to the level of multi-billion-dollar corporations. It's a force that makes smart people agree to do dumb things, simply because everyone else is doing them. Understanding this psychological underpinning is the first step in arming yourself against it. You begin to see that a company's actions are often not the product of a rational, data-driven business strategy, but the result of a primate's deep-seated fear of being ostracized from the tribe. To combat such a powerful instinctual force, you need an equally powerful mental tool. You need a blueprint that allows you to step outside the herd and analyze a situation from a place of pure rationality. This is where we codify the first part of Buffett's investment framework, the red flag identification system. This is a diagnostic tool, a checklist you can use when reading any annual report, listening to any earnings call, or analyzing any major corporate decision. Its purpose is to help you detect the telltale signs of a management team infected by the institutional imperative. The first red flag is the language of imitation. When a CEO justifies a major decision, like an acquisition or a large capital expenditure, do they primarily reference the actions of competitors? Phrases like, "This move allows us to achieve parity with our rivals," or "We are entering this market to keep pace with industry trends," are giant, waving red flags. A rational CEO, a true capital allocator, justifies decisions based on an expected return on investment, not on a desire to play follow the leader. They should be able to say, "We are investing X dollars in this project, and we expect it to generate Y dollars of cash flow over the next Z years, resulting in an attractive rate of return." Any justification that leans on what competitors are doing is a sign of weak, herd-like thinking. The second red flag is a focus on growth in aggregate size over growth in per-share value. The institutional imperative loves growth for its own sake. A bigger empire means more prestige, higher pay, and a bigger photograph in the annual report for the CEO. This often leads to diversification, as Peter Lynch called it, expanding into businesses the company knows nothing about, simply to get bigger. As an investor, you must be ruthlessly focused on per-share metrics. Is book value per share growing? Is free cash flow per share growing? A CEO who constantly trumpets growth in total revenue or total assets, while the number of shares outstanding is growing even faster through dilutive acquisitions, is destroying your value. They are growing the empire at your expense. Look for a CEO who speaks your language, the language of per-share ownership. The third red flag is resistance to shuttering or selling a failing division. Remember the textile mills. The managers were psychologically incapable of admitting their core business was a dud. When you analyze a company, look at its different operating segments. Is there a division that has consistently underperformed for years, earning low or negative returns on the capital invested in it? A rational, owner-oriented CEO would be ruthless in addressing this, either by fixing it, selling it, or shutting it down to reallocate the capital to a more productive use. A CEO in the grip of the institutional imperative will make excuses. They will talk about strategic importance, long-term potential, or brand synergy, all of which are often just euphemisms for, "I am too emotionally attached to this division to make the tough, rational decision." Your blueprint, then, is to become a diagnostician of corporate language and behavior. Create a simple scorecard. For any company you analyze, review its last 5 years of major decisions. For each one, ask, was the primary justification based on pure imitation or on return on investment? Did the action increase per-share value or just aggregate size? Have they shown a willingness to prune failing operations, or do they let them fester? This simple checklist acts as an intellectual vaccine. It helps you spot the symptoms of the institutional imperative before its value-destroying consequences show up in the stock price. Now, if this approach seems like simple common sense, it is crucial to understand that it is the polar opposite of how the vast majority of market participants operate. The path of the 99% is not just different. It is a direct endorsement of the very behavior we've identified as toxic. The average investor, and indeed most of the professional financial industry, actively rewards CEOs for succumbing to the institutional imperative. This is the great and tragic irony of the market. Consider the dot-com bubble of the late 1990s. This was perhaps the most spectacular, widespread outbreak of the institutional imperative in modern history. The social proof was overwhelming. Every company, regardless of its core business, felt immense pressure to have an internet strategy. Old-world industrial companies were spending billions to acquire fledgling dot-coms with no revenue and no business model. Why? Because their competitors were doing it, and Wall Street was punishing any company that looked like it was being left behind in the new economy. Imagine you are the CEO of a solid, profitable manufacturing company in 1999. Your stock is languishing because you are seen as boring. Meanwhile, your competitor announces the acquisition of a cash-burning website for $1 billion. Their stock immediately soars 30% on the news. Analysts praise their visionary leadership. Your board members are forwarding you articles about the deal. Your shareholders are calling, asking about your internet strategy. The pressure is suffocating. The rational decision, to state that the valuations are insane and you will not participate, is the path of maximum career risk. The irrational decision, to overpay for a meaningless dot-com asset, is the path of least resistance, and in the short term, the most financially rewarding for your stock price and your own compensation. The 99% of investors enable this behavior. They buy the story. They chase the momentum. They don't do the hard work of business analysis. They react to the headline. They cheer on the very acquisitions that are destined to destroy value down the road, because in the heat of the moment, it feels like progress. They mistake activity for achievement. The entire ecosystem of financial media, quarterly reporting, and analyst ratings is built around this short-termism. It creates a feedback loop where irrational, herd-like behavior is celebrated and rewarded, while rational, independent thinking is often punished in the short run. The 99% are not analyzing the company. They are analyzing the stock chart. They are not thinking like owners. They are thinking like gamblers betting on the next card to be turned. This is why understanding the institutional imperative is such a profound competitive advantage. While everyone else is cheering for the CEO to join the stampede, you are quietly looking for the rare leader who has the courage to stand still. The consequences of this herd-like behavior are not abstract. They leave a clear, quantifiable trail of destruction on a company's financial statements. The direct financial connection between the institutional imperative and poor returns is most starkly visible in a metric that cuts through all the corporate jargon: return on invested capital, or ROIC. Imagine a company has $10 billion of capital invested in its business. That's all the debt and all the equity that has been put into it over the years. If that company generates $1 billion in operating profit after tax, its ROIC is 10%. This number tells you how efficiently management is using the company's capital to generate profits. It is the ultimate measure of managerial competence. Now, consider two companies in the same industry. Company A's CEO is a rational, independent thinker. Company B's CEO is a slave to the institutional imperative. The industry is buzzing about a new, unproven technology. Company B, driven by the herd, invests $2 billion in this new tech, building flashy new facilities and acquiring speculative startups. Company A's CEO, after careful financial analysis, concludes the returns on this new technology are unlikely to be higher than their cost of capital and decides to wait or invest only a small experimental amount. In the short term, the market praises Company B for its bold vision, and its stock might outperform. But what happens to the numbers? Company B has now increased its invested capital from $10 billion to $12 billion. But the new projects are not yet profitable, or are only marginally so. Its operating profit might only inch up to $1.1 billion. Its ROIC has now plummeted from 10% to just over 9%, 1.1 divided by 12. Company A, by contrast, might have used its cash flow to pay down debt or buy back its own stock, actually reducing its invested capital while maintaining its profit level, thus increasing its ROIC. Year after year, this divergence continues. Company B keeps pouring capital into low-return Me Too projects, driving down its overall efficiency. Company A only deploys capital when it sees a high-probability chance of a high return. Over a decade, Company A will have generated vastly more cash for its owners, while Company B will have a bloated balance sheet and a legacy of underperforming assets. This is the slow, grinding reality of value destruction. It doesn't always happen in a single spectacular blow-up. More often, it's a quiet erosion of profitability, a death by 1,000 low-return cuts, all made in the name of keeping up with the Joneses. By focusing on ROIC, you can see the direct mathematical consequence of a CEO's mindset. It is the financial footprint of their thinking, a clear signal that separates the true capital allocators from the institutional mimics. Having diagnosed the disease, the institutional imperative, we can now turn our full attention to the cure. This is the core of the thesis, the mental model that Buffett uses to cut through the fog of corporate conformity. It is a question so simple it seems almost trivial, yet so profound it can reframe your entire approach to investing. The question is this: if I owned 100% of this business and it was not a public company, what would I do? This is the owner's question. It is an antidote to the madness of crowds, a powerful tool of critical thinking that acts as a shield against herd behavior. And there is no better story to illustrate its power in action than that of Katharine K. Graham and the Washington Post Company. In the early 1970s, K. Graham found herself in an unimaginable position. Following the tragic death of her husband, she was thrust into the role of leading her family's newspaper, the Washington Post. She was a woman in a man's world, surrounded by men who doubted her, in an industry facing immense change. It was during this period that Warren Buffett, through Berkshire Hathaway, became a major shareholder and a member of the Post's board of directors. He became not just an investor, but a teacher. And the central lesson he taught K. Graham was to stop thinking like the manager of a public company and start thinking like the sole owner of a private family business. The most powerful application of this lesson came during a period when the Post's stock was absurdly cheap. The market, for various reasons, was pricing the entire company at a fraction of what its individual assets, the newspaper, television stations, and other properties were demonstrably worth. The stock was trading at, say, $20 a share, while Buffett and Graham knew the true private owner value of the business was closer to $100 per share. What does the typical institutionally minded CEO do in this situation? They might continue with business as usual, perhaps making a small acquisition or paying a modest dividend. They worry about what Wall Street will think. They worry about sending the right signal to the market. But Buffett posed the owner's question to Graham. He said, in essence, "Kay, if you and I owned this whole place, and we knew it was worth $100 a share, and we could buy our partner's interest out for $20 a share, what would we do? We would back up the truck. We would buy as much as we possibly could. This is pure private owner logic. If you can buy a dollar for 20 cents, you do it, and you do it in size." Guided by this thinking, the Washington Post Company initiated a massive share buyback program. They used the company's own cash to purchase its own shares on the open market at these deeply discounted prices. For a public company at that time, this was a highly unconventional and aggressive move. Some on Wall Street were critical. But Graham, armed with the owner's question, had the conviction to ignore the noise. Every share the company bought back at $20 was like retiring a $100 liability for just $20. It was an investment with a guaranteed, massive return. This single series of capital allocation decisions, driven by a simple change in perspective, created billions of dollars in long-term shareholder value. It dramatically increased the remaining shareholders' ownership percentage in the wonderful business without them having to lift a finger. This is the owner's question in its most potent form. It is a lens of clarity that burns away the fog of short-term market opinion, institutional pressure, and career risk, leaving only the cold, hard, and beautiful logic of intrinsic value. The genius of the owner's question lies in its ability to rewire our brains, to short-circuit the psychological traps that plague both managers and investors. The first and most critical principle it exploits is the framing effect. How a question is framed has a massive impact on the answer. When a CEO asks, "What should we do to beat our earnings estimate this quarter?" or "How can we get our stock price up?" they are framing the problem from the perspective of a public market participant. Their mind is focused on external validation and short-term metrics. The owner's question masterfully reframes the entire situation. It removes the stock ticker from the equation. It silences the chorus of Wall Street analysts. By forcing the decision-maker to imagine a world where the business is 100% privately owned and illiquid, it changes the objective. The goal is no longer to please the market. The goal is to maximize the long-term, cash-generating ability of the business itself. Suddenly, actions that look good to the market, like a flashy but overpriced acquisition, are revealed to be what they are: a foolish waste of the owner's capital. And actions that might look boring or unambitious to the market, like paying down debt or buying back undervalued shares, are seen as the supremely intelligent moves they truly are. This reframing directly solves another deep-seated issue in corporate governance: the principal-agent problem. In a public company, the shareholders are the owners, the principals. The CEO and management team are their hired agents. In theory, the agents are supposed to act in the best interests of the principals. In reality, their interests often diverge. The principal shareholder wants maximum long-term per-share value. The agent CEO may also want that, but they are also motivated by things like salary, bonus, prestige, job security, and the size of their empire. A CEO might pursue a merger that grows the company, and thus their own compensation and status, even if it dilutes the ownership and value for the actual shareholders. This is the principal-agent problem in a nutshell. The owner's question magically dissolves this conflict. By asking a CEO, or yourself as an analyst, to think as if they were the 100% owner, you force them to mentally merge the roles of principal and agent. There is no one else to impress. There is no one else's money to spend, it's all your money. Suddenly, the temptation to engage in empire building, or to make decisions for reputational reasons, vanishes. The only thing that matters is the rational deployment of your own capital. You would never overpay for an acquisition with your own money just to look bold. You would never avoid shutting down a failing division just to save face. The question forces a brutal, productive honesty. It aligns the perspective of the decision-maker with the perspective of the long-term owner, which is the holy grail of successful corporate governance and value investing. So how do you, as an individual investor, put this powerful mental model into practice? You must run what I call the private owner simulation. This is a practical, step-by-step blueprint for applying the owner's question to any company you are considering investing in. It's an exercise in critical thinking that will fundamentally change the way you read financial reports and listen to management. Step 1. Mentally acquire the business. Before you do anything else, close your eyes and imagine you have just inherited this entire company. It's all yours. Every factory, every employee, every patent, every dollar of debt. You cannot sell it. The stock market, for the purposes of this simulation, does not exist. This mental step is crucial. It shifts you from a passive speculator to an engaged owner. Step 2. Imagine a 10-year lockup. Now imagine that you are legally forbidden from selling this business for at least 10 years. This forces a long-term perspective. The quarterly earnings number becomes irrelevant. The daily stock price fluctuation is meaningless noise. The only thing that matters is the strategic decisions being made today that will affect the business's health and cash-generating power a decade from now. Step 3. Audit the key decisions. With this owner's mindset firmly in place, open the company's most recent annual report. Ignore the glossy photos and the CEO's self-congratulatory letter for a moment. Go straight to the financial statements and the management discussion section. Your goal is to identify the 3 most significant capital allocation decisions the current management team has made in the past year or two. Did they make a large acquisition? Did they launch a major share buyback program? Did they invest heavily in a new factory or a new line of research and development? List these 3 key decisions. Step 4. Apply the owner's question. Now, for each of those 3 decisions, you will be the judge. Ask yourself, with the brutal honesty of someone whose entire net worth is on the line, if this were all my money and I couldn't sell this business for 10 years, would I have made that exact decision? Let's take an example. The company spent $5 billion to acquire a competitor. As the 100% private owner, you must ask, did we pay a fair price? Do we truly understand this new business we've bought? Are the promised synergies real or just corporate jargon? Or would my $5 billion have been better spent paying down debt, buying back my own shares at their current price, or investing in my existing high-return operations? This simulation forces you to move beyond passively accepting management's narrative and instead actively interrogating their decisions from the only perspective that matters: the owner's. If you find that you would have made different, more conservative, more rational decisions than the current CEO, you have uncovered a serious red flag about their management analysis and their alignment with your interests as a shareholder. The antithesis to this deep, ownership-focused analysis is the path followed by the 99% of market participants. They are not owners, they are renters. Their mindset is fleeting, their analysis shallow, and their time horizon is brutally short. The average holding period for a stock has shrunk from years to mere months. This is a direct reflection of a mindset that treats stocks not as ownership stakes in real businesses, but as flickering symbols on a screen, like digital playing cards in a global casino. The 99% investor wakes up and immediately checks their portfolio app. They are not asking, how did my businesses perform yesterday? They are asking, how did my stocks perform yesterday? The distinction is subtle but profound. Their emotional state is tied to the price, not the value. Their information diet consists of a fire hose of noise from financial news channels, Twitter feeds, and sensationalist headlines. These sources are engineered for one purpose: to generate clicks and viewership by triggering emotional responses, primarily fear and greed. They focus on what is urgent, not what is important. Market in turmoil as stock drops 5% is a much better headline than company patiently continues to compound intrinsic value at 15% per year. This creates a dangerous feedback loop. The investor consumes short-term noise, which encourages a short-term mindset. They then make decisions, buying or selling, based on that noise. They might sell a great company because of a single bad earnings quarter, or buy into a hot but wildly overvalued company because of a good news story. They are constantly reacting, never thinking. They analyze the company as a public stock, asking questions like, will it beat earnings estimates? Or what's the analyst consensus? The private owner simulation asks you to analyze the company as a business, asking questions like, is this business stronger and more profitable than it was last year? And is management deploying my capital intelligently for the long term? The path of the 99% is to be a spectator, a commentator, a critic of the stock price. The path of the owner is to be a partner in the business enterprise. By choosing to adopt the owner's question, you are fundamentally choosing to play a different game than almost everyone else in the market. While they are being tossed around by the waves of daily sentiment, you are standing on the solid ground of business reality. The direct financial connection of this mindset shift is profound, and it centers on one of the most important concepts in all of finance: capital allocation. A CEO has 5 basic options for the cash a business generates. 1. Reinvest it back into the existing business. 2. Acquire another business. 3. Pay down debt. 4. Pay a dividend to shareholders. 5. Buy back the company's own stock. That's it. The long-term success or failure of any company is simply the cumulative result of thousands of these capital allocation decisions made over time. A CEO who thinks like an agent, driven by the institutional imperative, will consistently make poor capital allocation decisions. They will reinvest in low-return projects to chase growth. They will make overpriced acquisitions to build their empire. They will be reluctant to buy back stock even when it's cheap because it's not as exciting as doing a deal. A CEO who thinks like a private owner, guided by the owner's question, will treat the company's cash as sacred. They will be a ruthless investor, always seeking the highest possible return for each dollar of capital. They will only reinvest in the business if the returns are high. They will only make an acquisition if the price is sensible and the strategic fit is perfect. And crucially, if they can't find any high-return opportunities, they will have the discipline to return the capital to the shareholders, either through dividends or, more powerfully, through buying back undervalued shares. This difference in approach creates a massive divergence in shareholder value over time. Consider 2 identical companies, each generating $1 billion in free cash flow per year. Company A's CEO, the empire builder, uses that cash to make a series of mediocre acquisitions, adding to revenue but earning a paltry 5% return on the invested capital. Company B's CEO, the owner-thinker, determines that no attractive acquisitions are available and their stock is cheap, so they use the $1 billion to buy back 10% of the company's shares. What happens? After 1 year, a shareholder in Company A still owns a piece of a larger but less profitable and more complex business. A shareholder in Company B now owns a 10% larger stake in the same great business they owned a year ago. Their slice of the pie got bigger without them spending a penny. Repeat this process for a decade. Company A becomes a bloated, inefficient conglomerate with a terrible ROIC. Company B becomes a lean, profitable machine that has retired a huge portion of its shares, dramatically increasing the per-share earnings and intrinsic value for the remaining owners. The owner's question is the philosophical engine that drives this superior capital allocation, creating a tangible, massive, and ever-widening financial advantage for its shareholders. If the institutional imperative is the disease and the owner's question is the cure, then the graveyard of ambition is littered with the casualties of those who failed to heed the lesson. To truly appreciate the destructive power of herd-like thinking, we must examine its most spectacular failure, a case study in corporate insanity that serves as a permanent warning to all investors. This is the story of the merger of America Online and Time Warner in the year 2000. It was billed as the, quote, deal of the new millennium. A perfect marriage of new media and old media, a visionary combination that would dominate the future of content and distribution. In reality, it was the single greatest, most value-destructive merger in corporate history, a direct result of the institutional imperative at its most virulent. The context was the peak of the dot-com bubble. The pressure to have an internet strategy was at a fever pitch. Time Warner, a behemoth of old media with iconic assets like Warner Brothers Studios, HBO, and Time Magazine, felt this pressure intensely. Its CEO, Gerald Levin, was haunted by the fear of being seen as a dinosaur, of being left behind by the digital revolution. He saw his company's stock languishing, while technology stocks with no profits soared to astronomical valuations. Across the table was Steve Case, the CEO of AOL, the king of the dial-up internet era. AOL stock had ridden the bubble to an absurd height, giving it a market capitalization even greater than Time Warner's, despite having a fraction of its revenues and profits. The institutional imperative was screaming in Gerald Levin's ear. The herd was stampeding toward the internet. His competitors at Disney were making digital acquisitions. Wall Street was demanding a bold move. The social proof was absolute. And so, he made the fateful decision. He agreed to have Time Warner, the profitable, asset-rich company, be acquired by AOL, the wildly overvalued darling of the bubble, in an all-stock deal. He was essentially trading real, tangible assets and cash flows for what amounted to digital confetti. It was a decision that no rational private owner, sitting in a quiet room and analyzing the fundamentals, would have ever made. A private owner would have looked at AOL's valuation and laughed. They would have seen that its entire business was built on slow, dial-up internet access, a technology that was about to be rendered obsolete by broadband. They would have seen the massive cultural clash between the freewheeling tech company and the button-down media conglomerate. But Gerald Levin wasn't thinking like a private owner. He was thinking like the captain of a massive institutional ship, terrified of missing the tide that everyone else was sailing on. He was chasing the story, not the value. The aftermath was a catastrophe of biblical proportions. The dot-com bubble burst shortly after the merger closed. AOL's business model collapsed as users flocked to broadband. The promised synergies never materialized. In fact, the two corporate cultures clashed violently. The company, now called AOL Time Warner, was forced to take a goodwill impairment charge of nearly $100 billion, an accounting admission that they had massively, insanely overpaid. It remains the largest annual corporate loss in U.S. history. The stock price collapsed, wiping out hundreds of billions of dollars in shareholder wealth. Careers were ruined, reputations were shattered, and a generation of investors was scarred. The AOL-Time Warner merger is the ultimate cautionary tale. It is a monument to the destructive power of the institutional imperative. It shows how the fear of being left behind, the pressure to conform to a popular narrative, can lead even the most powerful and experienced executives to abandon all logic and make a decision that, in hindsight, looks like pure madness. It stands as a permanent reminder that when the herd is running, the most profitable and often the safest thing to do is to stand still and ask the simple, powerful owner's question. The psychological drivers behind disasters like the AOL-Time Warner merger are a toxic cocktail of human biases, amplified by the high-stakes environment of the C-suite. The first ingredient is the overconfidence bias. CEOs, by their very nature, are confident people. To get to the top of a major corporation, you have to have an immense belief in your own abilities. This confidence is often a great asset, but it can curdle into a dangerous hubris. A CEO who has successfully managed a media empire, like Gerald Levin, can begin to believe they have a golden touch, that they can successfully manage any business, even one in a rapidly changing technological field they don't fully understand. This overconfidence leads them to underestimate the challenges of a merger and overestimate their ability to create synergies. They believe they are the exception to the rule that most large mergers fail to create value. They fall in love with the idea of the deal and their own role as a visionary leader, blinding themselves to the risks. This overconfidence is then supercharged by a phenomenon known to behavioral economists as the winner's curse. The winner's curse is most easily understood in the context of an auction. Imagine a jar of coins where the bidders don't know the exact value inside. Each bidder makes their own estimate and places a bid. The person who wins the auction is, by definition, the person who had the most optimistic, and therefore most likely incorrect, estimate of the jar's value. The very act of winning implies that you have probably overpaid. Corporate acquisitions are, in essence, auctions. When a company becomes an acquisition target, multiple suitors often emerge. A bidding war can ensue, driving the price up. The company that ultimately wins the deal is the one whose management team was the most optimistic about the target's future, the most aggressive in its assumptions about synergies, and willing to pay the highest price. As Charlie Munger has pithily observed, it's the triumph of the overbidder. The CEO of the acquiring company feels the thrill of victory, of vanquishing their rivals. They hold a triumphant press conference. But in the quiet light of the following years, as the promised synergies fail to materialize and the acquisition becomes a drag on earnings, the curse reveals itself. They won the battle, but they lost the war for shareholder value. The combination of a CEO's inherent overconfidence and the structural trap of the winner's curse makes value-destroying acquisitions a depressingly common outcome, a direct result of ignoring the sober, restraining influence of the owner's question. To avoid investing in the next AOL Time Warner, you need a systematic way to evaluate a management team's history. Past behavior is the best predictor of future behavior. This brings us to our next blueprint, the post-mortem analysis. This is an investment framework for acting like a corporate historian, digging into a company's past major decisions to grade the CEO on their actual track record of capital allocation, not just their charismatic promises. Step 1. Identify the defining decisions. Go back through the last 10 years of the company's annual reports and press releases. Your goal is to find the 2 or 3 most significant, company-altering capital allocation decisions made under the current leadership. This could be the acquisition of another large company, the sale or spin-off of a major division, a massive investment in a new product line, or a huge multi-year share repurchase plan. These are the decisions that truly moved the needle. Step 2. Uncover the original rationale. For each of these major decisions, you must become an archaeologist. Dig up the original press release, the investor presentation, and the quotes from the CEO at the time the decision was announced. What exactly did they promise? If it was an acquisition, what were the specific synergies and earnings accretion numbers they projected? If it was a major investment, what was the expected return on capital they articulated? You must understand the initial sales pitch they gave to their shareholders. Step 3. Investigate the actual results. This is the crucial step where you become a detective. Years have passed since the decision was made. Now you must determine what actually happened. Did that big acquisition ever deliver the promised profits? You may need to dig through subsequent years' financial statement footnotes to see if the acquired division's performance is broken out. Often, companies will conveniently stop reporting on it if it's a failure. That silence is, itself, a piece of data. Did that massive factory expansion ever earn a decent return? Or is it now a drag on the company's margins? Did the share buyback actually reduce the share count, or was it just enough to offset the flood of new shares issued for executive stock options? Step 4. Assign a grade. Based on your investigation, give the management team a grade A, B, C, D, or F on each major decision. Were they brilliant capital allocators, or were they serial value destroyers? A CEO with a history of making flashy, overpriced acquisitions that fail to deliver is highly likely to do it again. A CEO with a history of disciplined, high-return investments and shrewd buybacks has earned your trust. The post-mortem analysis provides you with a concrete, evidence-based view of a CEO's mindset and competence. It immunizes you against their future charisma and forces you to judge them on the cold, hard facts of their past performance. The reason a tool like the post-mortem analysis is so necessary is that the 99% of investors are perpetually trapped in the present, swayed by narratives rather than evidence. When a big merger is announced, the path of the 99% is to get caught up in the excitement of the story. The financial news networks roll out the special report graphics. They bring on experts and analysts to discuss the transformational nature of the deal. They focus on the grand, strategic vision articulated by the CEOs in the press conference. The narrative is almost always compelling. It's about synergy, about creating a dominant market leader, about positioning for the future. The average investor hears this story and gets excited. They see the stock price of the acquiring company jump on the news, and their fear of missing out kicks in. They buy the stock, effectively endorsing the merger without having done a shred of independent analysis. They are buying the press release. They are not asking the hard, skeptical questions that an owner would ask. How much are we paying? What is the track record of this management team in integrating acquisitions? What could go wrong? The 99% outsource their critical thinking to the market and the media. They accept the story at face value. This is why they are so often the ones left holding the bag when the story unravels, when the synergies turn out to be illusions, and the massive goodwill write-downs are finally announced. They were seduced by the promise of the future, without ever doing the boring, essential work of investigating the past. They are always focused on the wedding, never the marriage. The financial evidence of these past sins is often hidden in plain sight on the company's balance sheet. The direct financial connection, the numerical tombstone marking the graveyard of ambition, is an accounting item called goodwill. When one company acquires another, it records the fair market value of the assets it bought, things like factories, inventory, and patents. However, the acquirer almost always pays a price that is far higher than the value of these tangible assets. This premium, the amount paid above and beyond the identifiable assets, is put on the acquirer's balance sheet as an intangible asset called goodwill. In theory, goodwill represents things like the value of the target's brand name, its customer relationships, or other non-physical assets. In reality, goodwill is often simply the mathematical remainder of a massive overpayment. It is the accounting ghost of the winner's curse. A balance sheet that is bloated with a huge amount of goodwill relative to its tangible assets is a giant red flag. It tells you that the company's current size and shape are primarily the result of expensive acquisitions, not organic growth. It is a sign that management has been on a shopping spree. While goodwill itself isn't inherently evil, a history of constantly adding more and more of it, followed by periodic impairment charges, which is when the company finally admits the goodwill is worthless and writes it down, taking a huge hit to earnings, is the clearest possible sign of a management team infected by the institutional imperative. It is the financial scar tissue of past empire building. Contrast this with a company that has grown organically, developing its own products and services. Its balance sheet will be clean, dominated by productive assets like property, plant, and equipment. By learning to read a balance sheet and view a large goodwill account with extreme skepticism, you can see the financial residue of a CEO's thinking, distinguishing between those who build value from the ground up and those who simply buy it at a dangerously high price. Having explored the problem, the solution, and the consequences, we now arrive at the most important part of the journey, the practical application. How do we internalize this way of thinking and make it a natural, reflexive part of our investment process? We need to learn to see the world not as a ticker tape of stock prices, but as a landscape of operating businesses. We must learn to see with an owner's eyes. The pivotal moment in Warren Buffett's own evolution as an investor provides the perfect foundational anecdote. It was his 1972 acquisition of See's Candies. For years, Buffett had been a disciple of his mentor, Ben Graham, practicing a form of cigar butt investing, buying statistically cheap, often terrible businesses with one last puff of profit left in them. It was his partner, Charlie Munger, who pushed him to evolve. Munger convinced Buffett to pay what seemed like a high price, 3 times its book value, for See's Candies, a business of wonderful quality. This acquisition was a turning point because it forced Buffett to fully adopt the owner's mindset, not just as an analyst of public stocks, but as a buyer of entire businesses. When Buffett and Munger looked at See's, they didn't just see a set of financial statements. They asked the owner's question. If we owned this entire business, what would we have? They saw a business with a powerful, durable brand name that resided in the minds of its customers. They saw a product that people bought for emotional reasons, giving it immense pricing power. They realized that every year they could raise the price of their boxed chocolates by a little bit, and customers would happily pay it because the brand represented quality and nostalgia. Most importantly, they saw a business that required very little capital to grow. It didn't need massive, ongoing investments in research or equipment. It was a cash-generating machine. A typical public market analyst in 1972 might have looked at See's and seen a boring, low-growth company and passed on it. But Buffett and Munger, thinking as 100% owners, saw a financial masterpiece. They knew that as owners, their strategy would be simple: raise prices modestly each year, maintain quality, and pull the ever-increasing torrent of cash out of the business to be deployed elsewhere. And that is precisely what they have done for the past 50 years. See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway on an initial investment of just $25 million. It became the prototype for the kind of business Buffett would seek for the rest of his career. One with a durable competitive advantage, or moat, that gushes cash with minimal capital requirements. The See's Candies story is the perfect illustration of seeing with an owner's eyes. It's about looking past the superficial growth numbers and understanding the underlying economic engine of a business, asking the fundamental question: as an owner, what would the cash flow dynamics of this enterprise look like over the next 20 years? Adopting this perspective triggers a powerful shift in your own psychology. Two key principles are at play: the endowment effect and mental accounting. The endowment effect is a well-documented cognitive bias, where people place a higher value on an object that they own than they would be willing to pay for the same object if they did not own it. By running the private owner simulation and mentally owning 100% of a company before you invest, you are deliberately invoking this effect for your own benefit. Suddenly, the business is no longer just a ticker symbol, it's your business. This heightened sense of ownership makes you a much tougher grader of the CEO. You're not just a detached observer, you're their boss. You will scrutinize their capital allocation decisions with the critical eye of someone whose own money is at stake, because in your mind it is. The standard for performance becomes dramatically higher. You are no longer asking, is this management team okay? You are asking, is this the best possible CEO in the world to be running my company? This process also shatters the flawed logic of mental accounting. Mental accounting is our tendency to treat money differently, depending on its source or its intended use. For example, people are often more willing to gamble with house money they've won at a casino than they are with money from their paycheck. The same is true for investing. Many people treat their investment portfolio like market money, taking risks they would never take with their primary savings. They see a stock go up and feel like they're playing with profits, making them more susceptible to speculation. The owner's question destroys this artificial barrier. By viewing the company's capital as your own, you break down the distinction. A dollar of retained earnings on the company's balance sheet is treated with the same respect as a dollar in your own checking account. When a CEO decides to spend $1 billion of that corporate cash on an acquisition, the simulation makes you feel as though they just withdrew $1 billion from your personal bank account to do it. This creates an immediate, visceral connection to the consequences of their decisions. You are no longer dealing with abstract corporate funds, you are dealing with your capital. This simple but profound shift in mental accounting makes you a far more rational, disciplined, and business-focused investor. Now let's translate this mindset into a concrete, repeatable process. The blueprint for seeing with an owner's eyes is the annual letter litmus test. The CEO's annual letter to shareholders is the single most important document for evaluating the quality of management. Most investors skip it or give it a cursory glance. But for you, armed with the owner's perspective, it is a goldmine of information. This test is a step-by-step guide to reading that letter not as a public relations document, but as a direct report from the person managing your money. Step 1. Search for candor. The first thing to look for is a willingness to openly and honestly discuss mistakes. A CEO who thinks like a PR agent will only talk about successes, blaming any failures on external factors like the economy or foreign exchange rates. A CEO who thinks like an owner knows that business is hard and mistakes are inevitable. They will address their errors head-on, explain what they learned, and detail how they will avoid repeating them. Warren Buffett's annual letters are the gold standard here. They are famous for their humor, clarity, and brutal honesty about his own investment blunders. Candor is the hallmark of a leader who respects their shareholders as true partners. Step 2. Check the denominator. Pay close attention to the metrics the CEO focuses on. An institutionally minded CEO will trumpet aggregate numbers. We grew revenues to a record $10 billion. An owner-oriented CEO knows that aggregate numbers are meaningless without context. They will always speak in per-share terms. We increased book value per share by 15%. We grew earnings per share from $5 to $6. The focus on the per-share denominator shows that the CEO understands their primary job is not to grow the empire, but to increase the value of each individual share of ownership. Step 3. Demand a plan for your cash. The letter must clearly articulate how management plans to use the cash the business generates. Vague platitudes about investing in growth are not acceptable. A true partner will lay out their capital allocation strategy with clarity. They will explain the rationale behind their reinvestment decisions, their acquisition strategy, their dividend policy, and their approach to share buybacks. They should be able to explain why they believe their chosen path is the one that will create the most long-term value for you, the owner. If the letter is filled with corporate jargon and lacks a clear, logical plan for your capital, it is a major red flag. The annual letter litmus test is your opportunity to have a one-on-one meeting with the CEO. By reading their words through this critical lens, you can determine if you are dealing with a candid, shareholder-focused partner or a self-serving institutional manager. The antithesis of this deep, analytical approach is the path taken by the 99%, the consumption of financial infotainment. The majority of people who participate in the stock market do not get their information from reading dense annual reports. They get it from sound bites on financial television, push notifications on their phones, and algorithmically curated headlines on news websites. This entire media ecosystem is designed to do the opposite of what the owner's mindset requires. It prioritizes speed over depth, emotion over logic, and narrative over numbers. Consider a typical financial news segment. A host brings on two experts to debate whether a stock is a buy or a sell. They have 90 seconds to make their case. There is no time for a nuanced discussion of capital allocation or return on invested capital. Instead, they rely on heuristics and buzzwords. They're a leader in a hot space. The chart looks bullish. There's a lot of momentum behind this name. This is not analysis, it is performance art. It is designed to create a sense of action and urgency, to make the viewer feel like they need to do something right now. The owner's mindset, in contrast, is rooted in patience and inactivity. It recognizes that the best course of action is often to do nothing at all. The 99% are bombarded with information that encourages them to act like day traders, while the owner is quietly and diligently studying the long-term fundamentals of the business. By consciously choosing to tune out the noise and tune into the source documents like the annual report, you are giving yourself an almost unfair advantage over the vast majority of market participants who are being willingly distracted by the financial circus. Ultimately, the goal of seeing with an owner's eyes is to focus on the one metric that matters most to a private business owner: cash. The direct financial connection here is the analysis of free cash flow, or FCF. Free cash flow is often called owner's earnings because it represents the actual amount of cash that an owner could theoretically pull out of the business in a given year without harming its operations. It is calculated by taking the company's operating cash flow and subtracting the capital expenditures necessary to maintain and grow the business. This number is the purest measure of a company's profitability. Unlike net income, which can be manipulated with all sorts of accounting assumptions and non-cash charges, free cash flow is much harder to fake. It's the simple, cold, hard cash left over at the end of the year. A management team that is truly aligned with its owners will be absolutely obsessed with maximizing long-term free cash flow per share. Every decision they make will be evaluated against this single question: will this action increase the amount of cash our business generates on a per-share basis over the long run? They will see their primary job as widening the moat of the business to protect and grow that stream of cash. When you analyze a company, calculating its historical free cash flow per share and assessing its future prospects is the ultimate quantitative expression of the owner's mindset. It cuts through the noise of GAAP earnings, analyst estimates, and media narratives. It tells you the simple truth about how much cash your business is putting in your pocket each year. A consistent growing stream of free cash flow per share is the financial footprint of a wonderful business run by an owner-oriented management team. We have now reached the final and most crucial pillar of our framework. We've deconstructed the institutional imperative. We've armed ourselves with the owner's question. We've studied the catastrophic consequences of ignoring it. And we've learned how to apply this new lens to our own analysis. The final step is to learn how to read the results. We must become adept at looking at a set of financial statements and seeing not just numbers, but the clear, unambiguous footprints of a rational capital allocator. This is the financial X-ray that reveals the underlying health and intelligence of a company's leadership. And the perfect foundational anecdote for this is the story of Tom Murphy and Capital Cities/ABC. In his letters to shareholders, Warren Buffett has repeatedly called Tom Murphy the greatest business manager he has ever met. He is Buffett's model of a rational, owner-focused CEO. Murphy, along with his partner Dan Burke, built a media empire from a single bankrupt UHF television station into a powerhouse that eventually acquired the much larger ABC network. Their story is the polar opposite of the AOL Time Warner disaster. It is a masterclass in rational capital allocation. Murphy operated with a simple, powerful philosophy that was a direct embodiment of the owner's question. He ran capital cities with extreme decentralization and ruthless cost consciousness. He empowered the managers of his local newspapers and television stations to run their businesses as if they were their own. He loathed corporate bureaucracy and overhead. The company's headquarters was famously Spartan, a reflection of his belief that every dollar spent on corporate pomp was a dollar stolen from the shareholders. But his true genius was in capital allocation. Murphy was a machine when it came to deploying cash. He and Burke would only make acquisitions when the price was right, often buying forgotten or unloved media properties during times of market panic. They were constantly calculating the expected return on any investment, whether it was buying a new printing press or acquiring an entire company. Their most audacious move was the 1985 acquisition of ABC. At the time, Capital Cities was a fraction of the size of ABC, one of the original Big Three broadcast networks. It was a minnow swallowing a whale. But Murphy, thinking like a private owner, saw immense value. He saw a bloated, inefficient bureaucracy at ABC that he knew he could streamline. He saw valuable assets that were being undermanaged. He financed the deal with the help of Buffett, who recognized a fellow rationalist and proceeded to work his magic. He slashed costs, improved operations, and turned ABC into a phenomenally profitable enterprise. Over their multi-decade tenure, Tom Murphy and Dan Burke produced returns for their shareholders that were simply staggering, vastly outperforming the market and all of their media peers. Their story is the ultimate proof of concept. It demonstrates that a relentless focus on owner-like thinking, rational capital allocation, and operational efficiency is the most powerful engine for creating long-term shareholder value that has ever been devised. The reason most investors fail to identify managers like Tom Murphy is that they are susceptible to a pair of powerful psychological biases that distort their perception of time and data. The first is recency bias, our natural tendency to give greater importance to recent events than to events in the distant past. An investor might see that a company has had 2 or 3 great quarters of earnings growth and conclude that it is a great business with great management. They are extrapolating the very recent past into the indefinite future. The second bias is the law of small numbers, our tendency to draw broad conclusions from a very small sample of data. Those 2 or 3 good quarters become the entire basis for the investment thesis. The owner's mindset is the perfect antidote to both of these biases. By forcing you to adopt a 10-year time horizon and to conduct a post-mortem analysis of a decade's worth of major decisions, it zooms you out from the short-term noise. You are no longer asking, "What has management done for me lately?" You are asking, what is the long-term, multi-decade pattern of behavior and results here? This long-term perspective allows you to see through the temporary good or bad luck that can affect any company in the short run. It helps you distinguish between a mediocre manager riding a temporary industry tailwind and a brilliant manager navigating a challenging environment with skill. It replaces the emotional, reactive thinking driven by recency and small data sets with the cool, rational, long-term analysis of a true business owner. It is about identifying the signal of managerial skill within the noise of quarterly fluctuations. To systematize this long-term analysis, we need our final blueprint, the shareholder value scorecard. This is a simple, quantitative framework for reading the financial footprints of management over a 10-year period. You don't need a complex financial model. You just need a spreadsheet and the discipline to look at the right numbers. The scorecard has 5 key metrics. For the company you are analyzing, you will track these 5 items annually for the past 10 years. Metric 1. Revenue growth versus shares outstanding growth. You want to see revenue growing significantly faster than the number of shares outstanding. If a company's revenue grew by 100% over a decade, but its share count also grew by 100% through dilutive acquisitions, your personal ownership stake has not grown at all. You are looking for efficient organic growth, not just empire building. Metric 2. The return on invested capital (ROIC) trend. As we've discussed, this is the master metric. Is the ROIC consistently high? Above 15% is a good benchmark. And is it stable or rising? A declining ROIC trend is a major warning sign that management is deploying new capital into less and less profitable ventures. Metric 3. The debt-to-equity ratio trend. A rational manager, like a prudent private owner, is wary of excessive debt. Is the company's leverage manageable and stable, or has management been piling on debt to fund risky acquisitions or massive buybacks at inflated prices? A clean balance sheet is a sign of a conservative, long-term oriented mindset. Metric 4. Free cash flow per share growth. This is the owner's earnings. Is this number consistently positive and, most importantly, is it growing over time on a per-share basis? This shows that the business's underlying economic engine is becoming more powerful and more valuable for you, the owner. Metric 5. Margin trends. Look at the gross, operating, and net profit margins. Are they stable or expanding? This indicates that the company has a durable competitive advantage, or moat, that allows it to fend off competition and maintain its pricing power. This shareholder value scorecard, when filled out for a 10-year period, tells a powerful story. It paints a numerical portrait of management's competence and their alignment with shareholders. It cuts through the stories and the promises and reveals the undeniable results. The antithesis to this deep, quantitative, historical analysis is the obsession that the 99% have with a single, often misleading number, earnings per share or EPS. The entire financial industry revolves around the quarterly ritual of the EPS beat or miss. A company might report EPS of $1.05, when the analyst consensus was for $1.04. The stock will soar on this beat, even if the beat was achieved through accounting gimmicks, a one-time tax benefit, or by dangerously underinvesting in maintenance or research and development for the quarter. Conversely, a company might report EPS of $1.03 and see its stock plummet, even if it spent heavily during the quarter on a brilliant new product that will generate massive cash flow for years to come. The 99% are so focused on this single, short-term, and easily manipulated number that they completely miss the bigger picture. They celebrate a CEO who is willing to sacrifice the long-term health of the business to make the quarter. The owner's question forces you to look behind the EPS number. It prompts you to ask, how was this earnings number generated? Was it high-quality, sustainable profit from the core business, or was it financial engineering? And did the actions taken to achieve this number enhance or diminish the long-term competitive position and cash-generating power of my business? By refusing to play the quarterly EPS game and instead focusing on your 10-year shareholder value scorecard, You are once again choosing to play a fundamentally different and more profitable game than the rest of the market. This brings us to the ultimate direct financial connection, the end game of this entire philosophy, the compounding of intrinsic value. A rational capital allocator who consistently thinks like an owner does something magical. They take the free cash flow the business generates each year and they reinvest it at high rates of return. This creates a powerful, virtuous cycle. A business that can earn a 20% return on its invested capital and has the opportunity to reinvest its profits back into the business at that same rate will become a ferocious compounding machine. Its intrinsic value, the true underlying worth of the business, will grow at a staggering pace. This is the holy grail of investing. The stock price may bounce around in the short term, driven by fear and greed, but over the long term, it will inevitably track the upward march of the company's intrinsic value. Let's use a simple example. Company A earns a 6% ROIC, typical of a highly competitive, mediocre business. Company B earns an 18% ROIC, the mark of a great business with a strong moat. Both companies retain half their earnings to reinvest for growth. After 10 years, an investment in Company B will be worth vastly more than an investment in Company A. It's not just an incremental difference, it's a life-changing one. The secret is not just finding a great business, but finding a great business run by a management team that understands this dynamic, a team that will intelligently and rationally allocate every dollar of your capital to perpetuate and accelerate this compounding machine. The entire framework we have discussed, from identifying the institutional imperative to applying the owner's question to analyzing the financial footprints, is designed to do one thing: to help you find these rare and wonderful enterprises. It is the ultimate tool for achieving true, long-term financial freedom by partnering with the best business managers in the world. You have just spent this time absorbing a powerful mental model, a new lens through which to see the entire corporate world. You've learned to identify the invisible force of the institutional imperative that causes so much value destruction. You have armed yourself with the owner's question, a simple but profound tool for cutting through the noise and aligning your thinking with that of the world's greatest investors. You now have a blueprint for analyzing management, for reading their history and their financial statements, and for distinguishing the truly rational, shareholder-focused leaders from the herd. This is more than just an investment strategy. It is a fundamental upgrade to your critical thinking toolkit. But what we have built together is a single powerful pillar in a much larger structure. Buffett's system of thought is not a collection of isolated tricks. It is a deeply interconnected network of mental models. Understanding management and capital allocation, as you now do, is the first and perhaps most crucial piece. But a brilliant CEO, a master capital allocator like Tom Murphy, is only as effective as the business they have to work with. A great jockey on a sickly horse can still only go so far. The next piece of the map, the critical link that connects everything we have just discussed, is understanding the nature of the business itself. It is the concept of the economic moat. The video that is now on your screen is the next logical step in this journey. It is the missing link between a great manager and a great business. It answers the question: what gives a company a durable competitive advantage that allows a great CEO to work their magic for decades? Think of it this way. What we have just built is the world's most sophisticated engine. But an engine needs a vehicle. The next piece of this puzzle is the blueprint for that vehicle. The indestructible chassis, the impenetrable armor that protects the business from competition. The ideas are connected. A great CEO is one who spends their time in your capital widening that moat. To fully grasp their genius, you must first understand the architecture of the fortress they are defending. So the choice you face right now is not simply whether to watch another video, it is a question of identity. Are you a passive consumer of interesting financial ideas, collecting disconnected facts? Or are you a dedicated architect, systematically building a complete mental arsenal for achieving financial independence? The casual observer stops here, satisfied with the new tool they have acquired. The serious student, the future master of the game, knows that a single tool is not enough. They seek to complete the set. If you are that second type of person, if you are committed to continuing your ascent, then the path forward is clear. Click on the video on your screen and acquire the next piece of the framework. Complete the bridge between great management and a great business. Continue your journey.